Dude, absolutely. Get that. Yeah, email me after the class. Email me that you write your name in, so whatever it is.
Last name or
Last. It's LT. Thank you. Okay. Can you hear me? Yeah. As with the first quiz, okay, as with the first quiz, can you hear me? Okay. As with the first quiz, I will let you know. Hey guys, come on. As with the first quiz, I will let you know when the quizzes are graded and I'll send you the solution at that time. So you're not pre-checking it and freaking out, but it'll be ready to pick up whenever the quizzes are done. So sooner than you think. No. Today we're going to wrap up the investment principles. There are a few loose ends I haven't touched. We've talked about looking at standalone projects, looking at projects with different lives, making choices. Today, I want to look at two things. One is what I call project optionality, and I'll explain very simply what I mean by that. Because up till now, the rule is the net present value is positive. You accept a project, the net present value is negative. You're going to reject a project. Today, I'm going to give you an escape hatch where you might take a project with a negative net present value, which sounds like an odd thing to do, but I'm going to talk about the optionality in projects. And I'll use the Costco Clinic to illustrate some of what I mean by the optionality. The other is, I'm also going to talk about projects. I mean, everything in capital budgeting is about projects for the future, right? Should I take a project? But the reality is you've taken projects in the past, and sometimes you might want to look back at how those projects have performed. In general, though, what are the reasons for looking back at past decisions? Why are some of the things we look back at past decisions as businesses, as human beings? One is you want to see how badly you've done. Why? You can't fix your inaccuracy in the other, but if you can learn to make better forecasts for the future. One is learning. What else? You got to hold people accountable, right? You ask me to take a $15 billion project and it screws up. I'm going to come back to you and say, hey, you made me spend 15 billion. So some of this is punishment and reward. So one is learning, the second is punishment, reward. Third is just because you've taken a project doesn't mean you're locked in. You can walk away from a project. You can abandon a project. And we can talk about, hey, how do you make that decision? So today, let me start with the optionality question. So rule in capital budgeting is the present value of the cash flows exceeds the initial investment. The net present value is positive, take the project. If it's negative, reject the project. Let me give you a few outs though when the net present value is negative. There are times when you look at a project, the net present value is negative, you might still take the project because it gives you the right to take another project down the road that's potentially more valuable. When people talk about strategic, this is what they're talking about, which is take a bad project because it gives you the right potentially to enter a new market. The second is this option to abandon that I talked about. Sometimes you hold back on long-term projects because you say, I'm going to get locked in if it's a bad project. What if I gave you a chance to walk away? When people talk about the value of flexibility, being adaptable, this is what I hear, the option to be able to walk away from your mistakes. And the third project, the third option that I want to talk about is the option to delay. In other words, you got a project that has a negative net present value today. It doesn't mean that project is worth nothing if you have the exclusive rights to that project. So let's start with the first of those options, the option to delay. Okay? So let's assume you have a project. The project is, if you look at the cash flows, it's greater than the initial investment. Your net present value is negative. But I give you the exclusive right to be able to take this project for the next 20 years. It's a bad project today, right? But it doesn't mean it has to be a bad project for the next 20 years. There is this possibility that your cash flows could improve, that technology could change, and this project, which is a negative net present value project, could become a positive net present value project in the future. I'll wager that almost every AI project that people are looking at right now is right now probably a negative net present value project. The market's still small, a lot of space. But if you have the exclusive rights to an AI technology that is superior, I will pay you billions of dollars for that technology, even though it's not viable today. So the option to delay is actually a very good way to think about patents and technology which are not viable today, but could be viable in the future. You're buying a call option. In this class, we're actually not going to go through the process of putting numbers on that option, but you could argue that that insight will allow you then determine that you will be willing to hold on to the rights for a project, even though right now this project doesn't look viable. I'll give you an example of what happens when companies lose sight of that value. In the early 1970s, a company called RCA, at that time, one of the leading electronics companies in the world. It made TVs, it had the largest market share of TVs in the US. Came up with a new product. And here's what the product was. It was a big box into which you put tapes and you could watch the tapes on your TV, the original VCR technology. And when they did the initial investment analysis, the net present value was negative, and for an obvious reason. What were people going to watch anyway, right? The demo tape that you sent over and over again. So they had this tiny market. They said, it's not worth taking this project. And here's where they made their fatal mistake. At that time, it was true. It was not a viable project. But they sold off the rights to that technology to Panasonic for a pittance. They said, it's worth nothing. They're paying me a few $100,000. You have it. And the rest, as they say, is electronics history. Panasonic and Sony developed the VCR technology. And 10 years later, RCA had to pay Panasonic for the rights to the technology they sold, and they paid 10 times more per year than what they sold the technology for. So if you have a viable technology, you basically have an option. You got to think of it as an option. And the more uncertainty there is about the future, and this is one of the things that makes options unique, the more valuable the option becomes. So if you're at the cutting edge of a business, you come up with the technology, the net present value is negative, do the right thing, don't take the project now, but then don't go ahead and get rid of that technology because it has a negative net present value today. In the valuation class, we'll talk about using this particular approach to value patents and exclusive rights, even if those patents and exclusive rights are not viable today. So that's the first option. The second one is what makes strategic people really excited. Let's suppose you're looking at a big market. The big market can be China, it can be AI, it can be whatever. You're thinking of entering the market. So you come up with a project to enter the market. I come up with the net present value of the project. And I come back and say, the net present value is negative. Don't do it. By itself, that is good advice. But then if you think about it, taking this initial project might give you the rights to a second project, a much bigger project. I'll make this explicit. Let's assume you're Marriott. You've never had a hotel in China. You decide to open 5 hotels in China. You do the NPV calculations. The NPV comes out to be a negative number. You say, I'm not going to open the hotels. And then somebody in that meeting says, but if you open these hotels and they do better than expected, which they might, you get the exclusive right to open 100 more hotels in China. Huge market. That second project basically is the option to expand into a big market. And you can already see why you might be willing to take a negative net present value investment in order to be in a big market. That's why I use AI as an example. Right now, many companies looking at AI, looking at projects, are probably looking at negative net present values, but they will still invest because it's too big a market to walk away from. It's a very dangerous option because you can see the allure of a big market then can lead you to take investments that you otherwise would not have taken. Which brings me to my third and final option, the option to abandon. The option to abandon is the options I'm describing are called real options in finance. They're called real options to contrast them with financial options. Almost everything you do in a finance class is with financial options, listed options. Real options are embedded in projects and in companies. The option to abandon gives you the right to walk away from an investment if it isn't coming up to what you need it to make. It's the only put option that you will run into in the real options world. So the way to think about this is the present value of your cash flows drop below what you can get by abandoning the project. You're going to abandon the project and walk away. The option to expand, the option to abandon, the option to delay. You think about the Costco clinic, which are the options that we kind of talk about but never really made explicit? I mean, we had a positive net present value, so I didn't have to draw on it, but we talked about the new subscriptions that could potentially come about. That's an option to expand. A new business you could add into, a new value you could add, which is not in the cash flows. You're not double counting. So these are options that are embedded in projects that might lead you to stop and say, the project has a negative net present value. It tells me something about whether I should take the project today, but these are the things I need to think about before I say, okay, I'm walking away from this project. Any questions about optionality? Yes. Yeah. Really going to be that much easier to create those 100 marginal hotels? I think you're asking the right question because in a sense, you can see how easy it is now to enter into big markets with bad investments and use the big markets argument. But there is a question you need to ask, but the question is not how easy is it, but how exclusive is the right? And here's what I mean by this. Let's assume Marriott opens 5 new hotels. What was my story? If they do better than expected, they can open 100 more hotels, right? But let's say there's no exclusivity. You know what I'm going to do if I'm Hilton? I'm going to let Marriott open the hotels. I'm going to watch, I'll put spies. I'll send people to actually stay in the hotels, see how full are they. They will report back to me. And if the hotels are doing better than expected, just as Marriott is getting ready to open 100 hotels, guess what I'm going to do? I'm going to preempt them. The key word here with options is exclusivity. You and only you should be able to be, use that option. And if that's not the case, you have to be very careful about justifying bad decisions on that market. Yes. Okay. Let's think about what is the most, what would give you supreme exclusivity? The government says, if you open these 5 hotels, we give you the exclusive right. So one is something enforced by somebody more powerful that can keep the competition out, right? That's supreme exclusivity. Could it be first mover? You're now moving down so if you think about this as a continuum from no exclusivity to complete exclusivity, you can think of every competitive advantage as somewhere in that spectrum. The closer you get to total exclusivity, the more option value there is. That's why patents are options. That's why exclusive rights, licenses are options. But if you talk about brand name, first mover, you're moving down the spectrum and you're talking about less value for that same option. So yes, go ahead. Yeah. How do you value, I guess, the initial cost, like that whole first? It's completely, so that's actually a very good question, right? So I know in the Marriott case, it's actually pretty easy. So I have first 5 hotels, I have the cost of the hotels, the cash flows, the net present value. Because it's hotels, I can give you the initial investment on the next 100. Right now, that net present value is probably a big negative number. Otherwise, I'd have just gone 105 up front. So right now, I know the cost of the extra 100 hotels. Based on what I know today, the expected cash flows in the 100 hotels is well below what it needs to be. But this is where there's the optionality. The first 5 hotels, I start to see the results. It leads me to revisit my forecast for the 100 hotels. So that's why I said if the first 5 hotels do better than expected, you're redoing the cash flows on those 100. So that's but it gets more difficult if I'm talking about AI as a market. So if a company says, we have an AI product, it's not very good right now, it has a negative net present value, should we do it? It's very difficult to think about what that second investment will be in this space. There'll be a lot of hand waving, and this is how companies can get into trouble in big markets, is with hand waving. And that's why I think the exclusivity question becomes a more critical question to ask. Can you and you alone do this second project? And if the answer is no, you should probably not use it to justify the first investment. Right? Yes. Not necessarily. Exclusivity just means I'm going to allow you to open 100 hotels. It's still the hotel business. You still have a cost of capital. All the exclusivity gives you is if things go better than expected, you and only you can now take that second investment. If you didn't have that exclusivity, guess what's going to happen? If everybody notices that China is a really lucrative market, they're all going to jump in at the same time. They're going to push down your margins and cash flows. Exclusivity gives you that protection to be able to take that second investment. Yes. Yep. You could, but you'd have to bring an option pricing. So the second project would be valued as an option. It'll be an out of the money option. But remember, options which are out of the money can still have value. So I would take the 100 hotels, I would come up with the net present value, which will be negative. I'll tell you up front, but it'll be S will be less than K. S will be the present value of the cash flows. K will be the cost of the 100 hotels. But using option pricing, you can actually value that second option, the second project as an option. It has to be greater than the negative net present value in the initial one. The reason I don't want to go in there is it does require that you get a little familiar with option pricing models. But once you get the logic, all you need to do as an extra step is bring in the option pricing models to value that second option. Yeah. That's how I understand all option. If put option, like the option for do I understand the same logic? Absolutely. So basically, let's give an example. Let's assume you're Airbus and I am Embraer. Embraer historically has made smaller jets, right? And corporate jets. Airbus has made the big commercial aircraft. Let's suppose Embraer wants to create a commercial aircraft in partnership with Airbus. So I come to you and say, let's create a partnership for larger aircraft, 50-50. Initially, you are a little reluctant to do it because you said this is a risky project, the net present value looks negative, but I give you the right to walk away from this investment the first 10 years of the investment, and I'll buy your 50% back. Often in partnerships, you often will see this option put in where one of the partners says, if you don't like this project, if you don't like the way it's going, I will buy your 50% back at a fixed price. That's the abandonment cost. You know, when you'll walk away, if the project is doing really badly, you'll hand the 50% back to me. So there'll be a period where you can do this. It is a put option. The amount that I'm willing to pay you becomes the strike price. And what you think you will get as cash flows by staying in the project will become the equivalent of the stock price. So basically, you can value the put option just the way you would do a call option. And if that abandonment value is enough, you might still take the project, your 50% stake, even though the net present value looks negative. In fact, when I think about put options, I think about flexibility, being able to walk away from your mistakes. You remember the old Goldman Sachs legend? It's gone now. There was a time when Goldman Sachs was legendary because it was viewed as, you know, when things went well, they found a way to make them even better. They took advantage of call options. And when things went badly, they somehow managed to slip away before everybody else discovered that things were going badly. Maybe it helps to have the Secretary of the Treasury be from Goldman Sachs. No? But this was the legend of Goldman Sachs, that they had put options. So in bad times, they didn't have the same cost that other investment banks do. And in good times, they made even more money because they took advantage of good times. To me, that's the essence of call and put options, is you're taking advantage of opportunities that come to you and you build on them. That's a call option. And when things are going badly, you are able to cut the cords much more quickly than everybody else. That's a put option. And with options, the more uncertainty there is, the greater the value to options. That's what makes them so attractive, is in the times of the greatest uncertainty, these options become more valuable. Yes. Right. No, they will have a negative, because if they had a positive net present value right now, you wouldn't wait. You just take them, right? There's no advantage to waiting if that 100 hotel project was already positive NPV, right? Because you're learning from it's like a test market. The first project acts like a test market. And if the test market does really well, you're reassessing the cash flows in the second project, right? It's not fixed. So what you're using is you're using what you learn on the first project as learning for the second project. And that learning can lead you to reassess the cash flows. So by the time you've learned and you recompute the net present value, it'll have become positive. But you don't know whether it's positive or negative until you take the first project. So it's very similar to what you're doing in test marketing. You spend the money up front on that bad project to learn more so that you can potentially take this really lucrative second project. So when you think about investment analysis, this is something that comes into play, and especially during COVID, this became a factor. If you remember in 2020, the economy shut down, and some companies were more adaptable, more flexible than other companies were. They were able to adapt to the fact that the economy had shut down. So during 2020, I looked at every sector on a weekly basis to see which sectors were being hurt, and within each sectors, which companies were doing better than other companies. Everybody was hurt by the economy shutting down, but not all companies were equally hurt. So one of the ways I classified adaptability is in terms of, of multiple factors. I looked at, do you have a small investment outlay or a big one? Large investment outlay companies were more locked in. They had more difficulty. So you looked at heavy infrastructure companies, pharmaceuticals. You had already spent the money. You could not walk away, as opposed to companies like technology or service or consulting, where you were in a better position to adapt as things change. And it's just one slice of history, one crisis. But during that period, when you looked at stocks, here's what I saw in 2020. I broke them down by the sales to invested capital. Sales to invested capital measures how capital intensive these companies are. So low sales to invested capital means you're very capital intensive. A high sales to capital ratio means you're less capital intensive. So you can look at the last column, and again, it's just one slice of history. Don't read too much into it. You can see the companies that were most capital intensive, had the lowest sales to capital ratios, were hurt the most during that crisis. Their stock prices dropped, their earnings collapsed, and it makes sense because the more you're locked in, the less flexible you are, the more you're going to be affected by the things happening around you. Which brings me to that last piece, right? Again, one of the things that bothered me when I took corporate finance classes was everything was about the next new project. And it's almost like you never look back at the past saying, how did our old projects do in terms of delivering cash flows and investments? And here's the reality. If you look at NPV analysis, companies never take bad projects, right? You look at their history, oh, every project, but you look at their actual projects, and you saw this with the return on capital, many of these projects, I would say as many as 2/3 of all projects deliver negative net present values ex post, after the fact. So the question is, what do we learn by looking at the past? And there are two reasons we do it. One is the punishment reason, right? You look at projects, says somebody's got to pay the price for a bad project. I think that's a less useful part, but still is part of business. You have to hold people accountable. The other is to change the way you do investment analysis. And I'll talk about what you can learn from past projects and that can help you change your way. So let's start with an existing investment. Let's say it's a 10-year investment and you are a couple of years into the investment. So you took the investment at a positive net present value. So what you see here are the original forecasts, F0 through F10. So when you did the capital budgeting, those were your original forecasts. And then you have the actual numbers come in for the first couple of years. So what are you discovering? You're discovering that your initial investment, you underestimated your cash flows. So you're discovering that the actual cash flows don't match up. to your forecast. So you're in year 2. The question you're asking is, what do I do about this project? So when you look at an existing project, you're looking at it 2 or 3 years into that project. So if you took the Costco clinic, and let's say we all took, Costco did open these clinics. 3 years from now, when I look at the clinics that have been opened and look at their cash flows, and I can match them up to yours, right? And 3 things are going to be true. One, and this is very unlikely, the actual cash flows are going to look exactly like your predictions. It's almost never going to be the case, but it could happen. The second is the actual cash flows are much higher than what you predicted. A lot of different reasons, or could be much lower. We know which one will make the company happier, but all 3 can play out. When you look at it play out, you are learning lessons that you can use for the future. So let's start by looking at the postmortem component first to see what you can learn by looking at the past. One is, as I said, in almost every project, the actual numbers are going to come in differently from the expected numbers. Since I value companies, this is something I run into all the time because people say, you forecast those numbers for Uber in 2014. I have the actual revenues in 2023. How come you were so wrong? What are the 2 reasons you can be wrong? One is there are mistakes you make, errors. The other is bias. What is bias? We're human beings. We bring in our preconceptions into our cash flows. If you really, really, really want to take a project, you find a way to inflate the revenues, inflate the margins. So when you look at the past, the first question you're asking is this a mistake or is this bias? How can you tell? If you have just a single project, it's impossible to tell, right? But let's say you've taken 50 projects in the last 20 years. If it's truly mistakes, what should you see on those 50 projects? About half of your projects, you should come in higher than expected. Half you should come in lower than expected, right? Things can happen. But if in 48 out of the 50, you come in below expectations, this isn't a mistake. This is bias. And bias will kill you as a company. Mistakes average out, but bias doesn't average out. So where does bias come from? So, if you wanted to reduce bias as a company in project analysis, what are some of the things you might do to reduce bias? Yes. First, never let the person pushing the project do the number crunching on the project, right? That's the first rule. It's amazing how often you see that rule violated. Divisional managers who want a project are then given the task of, hey, why don't you come up with the cash flows? And you say they're biased. Of course, they're going to be biased. So the first is you want to make sure that the people who really, 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 which means that the people who know the most about the project are often not the ones doing the number crunching, right? I mean, they should still be used, but you want to separate what else can you do to reduce bias? Yes. One is you want to also bring in people with very different perspectives. Don't have everybody from one group do the project analysis. Bring in people from different parts, especially if you're using their resources and you're pricing them out. They might say, look, you can't do this with 3 engineers. You'll need at least 5. And third, you got to make sure that if there is that bias is showing up, that people are held accountable. What amazes me, the M&A process to me is one of the most supremely biased processes. Think about why. Think of how acquisitions originate. They originate from the top down, right? The CEO. Already you can see the process and a pathway to bias. Because if you know your boss really wants this project to go through, and he or she says, look, do the cash flows, you know exactly what the cash flows need to look like for that person to be happy. Second, after the project is taken and you screw up, there's no accountability. What I mean by that is you do a $15 billion, make a $15 billion mistake, you pass it off. If the bankers did it, no, it was just a mistake. If you have no accountability and you turn the process over to people who are biased, of course you're going to get cash flows that reflect that bias. So when you look at the past, it's not just blaming people for mistakes, because that's wrong. In fact, I'll tell you what happens if you blame people for mistakes. they'll become risk averse. And when you're risk averse, what will you do? You'll undershoot your cash flows. You'll be turning away good projects because nobody got fired for not taking a project. You get fired for taking a project. It's a classic bureaucratic response that you often get in government companies, as government companies often will refuse to take projects unless they're guaranteed, because there's no upside to taking the project, and there's a lot of downside. So detecting which one's causing the cash flows to be different is critical, not just to hold people accountable, but to change the way you do. But let's turn to the more interesting question. You're 2 years into a project. The cash flows are coming in lower than expected. There are actually 4 choices you have, and which one you pick will really depend on that particular project. Here's the first one. You can say, okay, I'm shutting the project down. Sell off the assets you get, you liquidate the project. What you will get is the cash. So if you think about that, you'll just get what, maybe you'll get nothing if you liquidate the project. But you will do that if the present value of your future cash flows, now that you're in year 2, remember you reassess the future cash flows. If that present value is negative, you're saying, why would I keep throwing good money after bad? You know what's going to get in the way of doing this though? If you were the person who took the project 2 years ago, you're going to refuse to admit that you screwed up. You're going to hold on. Every time I see Giancarlo Stanton come up to the plate as a Yankee fan, I say, what are you guys doing? But he's going to be there for the rest of his contract. Why? Because Brian Cashman, who signed him, is still there. And I'm not saying this is somebody who dislikes Brian, but if you're the person who made a decision, it becomes very difficult to walk away because that's an admission of mistake. The second is you can terminate the project and get some kind of salvage value, sell off the assets. The difference in the first and the second, the first one, you basically get nothing. You just shut the project down and walk away. The second one, you're trying to get some cash flows, and you will do that if the salvage value you will get from the assets exceeds what you will get as cash flows from continuing the project. So you liquidate the project probably if your cash flows from this point on look negative. There's no point continuing it. The second one, your cash flows can be positive, but if your salvage value is greater than the present value of those future cash flows, you will salvage the project. The third thing you can do is to try to sell the project to somebody else. You see, if the project is bad for me, why would it be good for somebody else? Why might a project that has negative net present value to you now have value to somebody else? They might have a better way of exploiting. So you might have an exclusive license. You can't make much money, but maybe another company with that same exclusive license can generate higher cash flows. Or maybe they have a CEO who's got a big ego and they'll pay a premium. You don't care, right? At this point, you will just divest it. So if you get a divestiture value that exceeds the present value of the cash flows, you will sell the asset. So you can liquidate the project, you can salvage the project, you can divest the project. And there's a fourth thing that you can do, which requires a lot of gumption. The project's not going well, right? So maybe if you invest more in this project, you can fix it. So that'll require an additional investment in continuing the project, but something's got to change. So I would argue that in every project, every year, companies should be asking this question, should I liquidate? And they never do. They often assume that you have to keep with the projects, but this is something that, especially on large projects, companies should be re-examining. Someone using, yeah, go ahead. Liquidate basically means you walk away with nothing. You're doing this because your cash flows are now negative. So basically you're saying, hey, look, I get nothing, but nothing is better than negative. So I'm going to stop. Salvage means you can get something for the assets, but it's great. So your cash flows are positive, but what you get is a salvage value. So it's like a net present value decision from scratch. And it almost requires that you say, look, I don't care how much money I spent 2 years ago. I'll take what I can now because it's greater than the present value of future cash flows. Yes, Justin. You could put the salvage value of 0, but basically that is, to me, any project that's gone into negative territory, you might actually pay somebody to take this project off you, right? If it's that bad, just take it off my hands. Yes. Convince somebody, I'm sorry. It could be positive. So basically you try, at this point, you're just desperate, right? You know it's a bad project. You're saying, what do I do with it? But my point is people don't even make that choice. Sometimes they take bad projects, they say, stuck with bad projects, they say, what can I do? So I'm going to use an example. If any of you have been in Disneyland, about 20 something years ago, that used to be just a single park, a Magic Kingdom. So basically on one side, there used to be a parking lot on the other side. And about 25, maybe 20 years ago, they built a new park called California Adventure. It was supposed to be some replica of California with all the sun in the front. And their original hope was that if they built this theme park, 60% of the tourists who came into Magic Kingdom, it's actually just a walkway. So it's a 5-minute walk. You can walk from one park to the other. They would walk across California Adventure. So when they did their original capital budgeting, California Adventure, they estimated that the number of tourists who would come in would be 60% of the tourists going into Magic Kingdom. And it looked like a good project. And they took it. In hindsight, though, it turned out that California Adventure was too adult a park for families to bring their kids across. The actual percentage coming across was closer to 40% rather than 60%. That makes a huge difference. There are 15 million people going into California, into Magic Kingdom. Instead of 9 million coming, only 6 million are coming to California Adventure. So by the time they got to early 2008, Disney faced choices. California Adventure was not measuring up to what they thought would deliver. Its actual cash, its actual cash flows were below their expectations. So here are the three choices. They could shut it down and build hotels or whatever else, and they could recover about $500 million of the original investment. The original investment they had in the park was 1.5 billion. So they're not going to get their money back, but they could get $500 million back. So that's one option. Shut it down, get $500 million. The second is continue with the park as is. And if they do, the cash flows they're going to get are lower than the original expectation. It's going to be about 50 million a year going into perpetuity. And there's a third choice they faced. If they were willing to invest another 600 million in California Adventure and bring in more kid-oriented attractions, they thought they could increase the 40% back to 60%. So three choices. One is shut it down, get $500 million. Second is keep going with what you have. It's not a bad investment. It's just not as good as you thought it was going to be. The third is invest more and see if you can make the park a more attractive investment. It's a pure cash flow, net present value choice. The first one is easy. The net present value of the first one is $500 million. If you continue operations and you make 50 million, and the inflation rate is 2%, the present value of the theme park continuing as is about 1.1 billion. So already if I gave you the two choices, will you shut it down, make $500 million, keep going and make 1.1 billion? It's an easy choice. You're going to go with the 1.1 billion. But let's bring in the third choice. In the third choice, by investing another 600 million, you can increase the cash flows from 50 to 80 million. More kids are coming into the park. The present value of that incremental cash flow is about 662 million. What is it costing me to do the expansion? 600 million. I'm getting 662 million back. The third choice beats the continuing as is choice because it's a net present value of 62 million. In effect, it'll be 1.1 billion plus 62 million will be the total net present value of the third choice. Guess which one Disney went with? If you've been to California Adventure, they've invested huge amounts into California Adventure. They've gone with the third choice because in a sense, they feel, I don't know in hindsight whether it's paid off or not, but they've chosen to invest about $1.5 billion into California Adventure alone, maybe $1 billion. California Adventure alone over the last 15 years, trying to get more people. So when I go to Disneyland, one of the things I do is stand in the middle and watch how many people go back and forth. Is it 40%? Is it 60%? Is it 20%? Because for Disney, it makes a huge difference in terms of what the net present value of this park is. So when you look at existing investments, it's too easy to say we've already done that, it's a sunk cost, but there are choices you can make. And many companies, I think, don't look at those choices. The inertia drives the process. We've already done it, not much we can do. But I think by being dynamic and asking this question, you can make a better choice about which of the projects we should be investing more in, which of the projects we should be walking away from. Incidentally, in investing as individuals, There's this phenomenon people have noticed that people are unwilling to sell losers. They hold on to losers in their portfolio too long. It's the same phenomenon, right? Because you don't want to stop and ask a question, would I invest in this stock at this lower price? And the answer is no, you should be selling it. But because you don't want to admit a mistake, it stays on your portfolio. So it took us a long while. We're in session 16 of this class, of a 26 session class. But I think we've finally got the investment principle done. Let me remind you again, this is the very first class. We said the investment principle says you should invest in projects that earn a return that is greater than some minimum acceptable hurdle rate. I'll read the words that I read to you in the first session. And hopefully 16 sessions in, they carry more meaning. I said the hurdle rate should reflect the risk of the project you're investing in. How do we show that? What are the choices we make to make sure the hurdle rate reflects the risk of the project? When it comes to cost of equity, we use the beta of the project, not the beta of the company, looking at the project. We bring in the mix of debt and equity through a debt ratio in our cost of capital. And in doing all of this, we are making the assumption we're investing other people's money, right? Disney doesn't have money, it's investing. Now, where does the choice come in? By looking at only the risk you cannot diversify away. So the hurdle rate reflects the risk, and the risk is defined as beta for cost of equity and a default spread for cost of debt, and it feeds into a cost of capital. On the return side, we said the return should be based on cash flows. And we talked about incremental cash flows, why the cash flows that matter should be the ones we count on, should reflect the timing of those cash flows. And what do we do to reflect the timing? We do present values. That's what timing is. And should have all side effects built into it. What does that mean? The side costs and the side benefits we talked about should all be in those numbers we use when we look at the NPV or the IRR or the return on capital on a project. The reason I spent so much time in the investment principle is here's the truth. If you're a company that takes bad projects, I don't care how well you finesse your capital structure and how well you pay dividends, you're doomed as a company. Conversely, if you're a company that has great investments, I cut you a lot of slack, right? I mean, I'm not sitting here saying, does NVIDIA have an optimal debt ratio? Who cares? When you're making 45% returns on your projects, I'm going to say it doesn't matter whether you're at the right debt ratio, whether you're paying the right amount in dividends. There's a reason we spend so much time in the investment principle. But as we go through it, while it might seem like numbers and rules and principles, it's human beings making decisions. That's why we talked about sunk costs and how they alter decisions. I think acting like human beings are not involved is delusional. We have to develop investment principles and ways of looking at investments that take into account the biases of human beings, that factor it in. Don't assume it away. There's no point in denial. Ask yourself, how do I minimize the effect of those behavioral choices that human beings make? So many of you worked at big companies, you saw projects taken, acquisitions made. Think back to that process and think of if that process went wrong, what caused it? Yes, Zach.
So on that note about the human component, once a company has established a reputation like NVIDIA, how much leeway do you actually give them over a period of time if they repeatedly then are not according to that standard?
It depends on how successful they were, right? Right now, Jensen Huang is viewed as walking on water. I mean, he's viewed as the greatest CEO ever walked the face of the earth. And let's face it, NVIDIA has done some amazing things. And the thing about NVIDIA is you can't say it was just luck. And I'll give you the contrast. Novo Nordisk, amazing company in terms of returns, right? I don't even know who the CEO of Novo Nordisk is. And to be honest, I don't care. Because how did they get successful? They created a drug for something that suddenly became a drug that, Ozempic and Wegovy, that was for something else. That man, it was pure luck, right? So in the case of Novo Nordisk, your slack is much shorter. It's not like you're going to get a huge room for making mistakes because people know you got lucky. So at this stage, if you look at the market cap for Novo Nordisk, markets are not assuming magical things coming from the company, because I actually read a news story in the New York Times about how the culture and work hours at the company haven't changed at all. It's a Danish company. People come into work at 9, they leave at 5. Great work-life balance. which is a good thing if you're working there, but it's not a company that's going to come up with new drugs. At least that's not what the market is predicting. In the case of NVIDIA, it's been lucky 3 times. When you're lucky 3 times, you got to say this wasn't luck. This was something they did. In what way? They entered the gaming business with their chips well ahead of everybody else. They entered the crypto business before everybody else. And now at this point, you're saying if they're entering these new big markets before everybody else is doing it, it must be something within the company. So for the moment, they've got a huge amount of slack. You know what could cause it to disappear overnight is they did $1 trillion acquisition. This is why big acquisitions are so deadly, is you can take decades. And that I use the Eastman Kodak example, a company that had built up a huge amount of credibility over 30 years in one day. With that Sterling Drugs acquisition, they wiped it all out. So you do get slack unless you decide to make a really big mistake or a really big bet. And then I'm watching you again saying, hey, you have too much of my money with you and I don't trust you anymore. So it really depends on the company and what the company decides to do. Okay, so we're done with packet 1. If you can download packet 2 for Wednesday's class, we're going to start on the financing principle on Wednesday. Now, see you then.